Welcome back to Report of Silver, where we break down the latest developments in the gold and silver markets and help you understand not just what is happening, but more importantly, why it is happening. Today's move in silver gave us exactly the kind of trading session that reminds investors why this metal commands so much attention. Earlier in the day, silver looked weak, vulnerable, and under pressure. At one point, it appeared that the sellers had complete control, pushing the price sharply lower and convincing many traders that another major sell-off was underway. But then something changed. Late in the trading session, buyers stepped in aggressively, volume surged, and silver staged a dramatic turnaround that completely changed the tone of the market. That reversal is what we are going to talk about today, because it tells us something important about where silver may be headed next. If you follow this market closely, then you already know these reversals matter. They reveal where the real demand is hiding, and they often give us clues about what smart money may be doing behind the scenes. Before we begin, let me know in the comments. Do you believe silver reaches $80 before the end of this month, or do you think the market needs another correction first? Now let's begin with what happened during today's session. Silver was hit hard earlier in trading. At one stage, the price fell all the way down to roughly $74.37 an ounce. That is a serious intraday move, and when you see silver drop more than $2 in a short period of time, it naturally creates fear in the market. Traders begin to wonder whether momentum has shifted, whether institutional money is exiting, and whether another so-called Friday Smackdown type event could be developing early. But instead of continuing downward, silver found support. Buyers stepped in near that lower level and began absorbing the selling pressure. Slowly at first, and then much more aggressively, the price began to climb. By the end of the session, silver had recovered all of that damage and was trading near $76.76 an ounce, up roughly 1% on the day. That is a remarkable reversal. Think about what that means. A market that looked weak in the morning finished strong by the afternoon. That is not the behavior of a collapsing market. That is the behavior of a market where buyers are waiting for dips. That matters. It tells us that beneath the volatility, there is still strong interest in owning silver. What makes today even more interesting is that silver was outperforming gold. That does not happen every day. Gold, which usually acts as the steady anchor of the precious metals complex, was actually down slightly, hovering around $4,540 an ounce. Not a major drop, but enough to highlight the unusual relationship we saw today. Silver up strongly, gold flat to down. That tells us silver was not simply following gold. It was responding to its own drivers. We also saw strength in the broader metals complex. Platinum was higher, and palladium was actually the strongest performer of the day, gaining nearly 1.8%. When you see all of these metals moving higher together, it often suggests that investors are rotating back into hard assets. That does not always mean a new rally has begun, but it tells us sentiment may be shifting. So what triggered this dramatic silver reversal? Part of the answer lies in economic data. Earlier today, the Federal Reserve Bank of Philadelphia released its latest manufacturing survey, and the numbers were ugly. The Philadelphia Fed Manufacturing Index collapsed into negative territory, dropping to negative 0.4 after posting 26.7 the previous month. Economists were expecting a reading around 17.6, so this was a major miss. That is not just disappointing, that is a serious warning sign. Why does that matter? Because manufacturing data acts as a window into the broader economy. When factories slow down, it can signal weakening demand, slowing business investment, and possible recession risks. Normally, weak economic data like that should support gold and silver because investors begin looking for safe haven assets. But that is where the story gets more complicated. Gold did not react strongly because another force was pushing against it: rising bond yields and a stronger US dollar. Those two factors remain major headwinds for precious metals right now. Still, silver's rebound tells us something powerful. Even in an environment where the dollar remains strong and yields remain elevated, silver found enough buyers to reverse sharply higher. That is not weakness. That is resilience. And in markets, resilience often comes before strength. That is what makes today's session so important, and that is why every serious silver investor should be paying close attention. As we move deeper into today's market action, we need to talk about the broader macro picture because silver never trades in isolation. It reacts to a complex web of economic data, geopolitical developments, currency movements, energy prices, and investor psychology. Today was a perfect example of that. On the surface, it looked like a simple price rebound. Silver fell sharply, then recovered. But underneath that move, there were several competing forces pulling the market in different directions, and understanding those forces is how we figure out what may happen next. Let's start with the US dollar, because that remains one of the biggest variables for all precious metals. The US dollar index was trading near 99.22, pushing back toward that psychologically important 100 level. Normally, when the dollar strengthens, gold and silver struggle, because a stronger dollar makes metals more expensive for international buyers. It creates pressure. That is why today's silver rally was so notable. Silver was able to rise even while the dollar remained firm. That tells us there was something stronger than simple currency pressure at work. There was underlying demand. Now let's talk about bond yields, because they have also been a major headwind. Elevated treasury yields make non-yielding assets like gold and silver less attractive on paper. If investors can earn more interest by simply holding bonds, some money rotates away from metals. That has been part of the story recently, and it helps explain why gold did not move much today, despite weak economic data. But silver behaved differently because silver is not only a monetary metal, it is also an industrial metal. That dual identity often makes it respond differently than gold. And that brings us back to the manufacturing data from the Federal Reserve Bank of Philadelphia. The collapse in the Philadelphia Fed Index was dramatic. It did not just miss expectations, it fell off a cliff. A move from 26.7 down to negative 0.4 signals a sharp slowdown in activity. The report showed declines in current activity, new orders, and shipments. Those are not healthy signs. It suggests businesses in that region are becoming more cautious, and that caution could spread if similar data appears elsewhere across the country. Interestingly, the labor component also remained weak. Employment in the region stayed negative, which means companies are still hesitant to hire. That is not what you want to see if you believe the economy is strong. And inflation indicators inside the report also softened, with the prices paid index falling noticeably. That matters because it may suggest some cooling in pricing pressure, which could eventually influence how the Federal Reserve thinks about future policy. Now, many investors would look at that and say, shouldn't that be bullish for gold and silver? In the medium term, yes, it probably is. Weak economic growth combined with softer inflation can eventually support precious metals because markets begin to price in easier monetary policy. But in the short term, markets are emotional. They react to headlines, bond yields, and dollar strength. That is why gold remained subdued. Silver, however, appears to be looking beyond today. It may already be pricing in a longer-term story. Another important factor today was oil. West Texas Intermediate crude oil slipped back below $100 per barrel, trading near $97.89. That decline may not sound dramatic, but it matters because energy prices influence inflation expectations and risk sentiment. Recently, we have seen an unusual relationship where oil falls while silver rises. Historically, that is not always the normal pattern, but during geopolitical stress, markets can behave differently. Investors start looking at metals as protection, while energy markets respond to supply expectations. This brings us to the geopolitical layer, specifically the ongoing tensions involving Iran. Markets continue to watch that situation closely. Every new headline has the potential to move oil, currencies, and precious metals in seconds. Silver traders know this. They understand that geopolitical uncertainty often creates demand for hard assets. Even if silver is more volatile than gold, it still benefits from that safe haven narrative during periods of instability. And that is what makes today's move fascinating. Silver was not rising because everything was perfect. It was rising despite multiple headwinds: a stronger dollar, elevated yields, weak manufacturing, falling oil, geopolitical uncertainty. Normally that combination creates confusion, but silver found direction. Buyers stepped in and said, "We want exposure here." That is often how major market shifts begin. Not with a clean breakout, but with a surprising show of strength when conditions do not seem ideal. Today may not guarantee that silver goes to $80 tomorrow, but it absolutely tells us that this market is not ready to give up. The bulls are still here, and they are defending key levels aggressively. That is something every silver investor should be paying attention to as we move toward the end of the week. Now let's focus on the technical side of today's move, because while headlines and macroeconomic data explain part of the story, the price action itself often tells us even more. Silver is one of the most emotional and volatile markets in the world, and that volatility can confuse investors who are not used to it. One moment it looks like the market is collapsing, and a few hours later it looks like a breakout is underway. That is exactly what happened today, and understanding that behavior is essential if you are investing in silver for the long term. Earlier in the session, silver was under intense pressure. Sellers pushed it aggressively lower, taking the price down to roughly $74.37 an ounce. That level immediately caught the market's attention because it represented a key support zone. In recent weeks, we have seen silver establish a broad trading range, with support forming near the low 70s and resistance developing in the upper 70s to near $80. That range has become the battlefield between buyers and sellers. When silver dropped toward the lower half of that range today, it looked like the bears were trying to force a breakdown. But that breakdown never happened. Instead, buyers stepped in quickly and absorbed the selling. That tells us something very important. It means there are market participants, likely larger institutional players, commercial hedgers, or physical buyers, who view these dips as opportunities rather than reasons to panic. They are not waiting for cheaper prices. They are buying when the market gives them a discount. That kind of behavior creates support. And support is what saved silver today. Once that floor held, momentum began shifting. The sellers started losing control, and as short-term traders realized the market was not breaking down, many of them began covering their short positions. That adds buying pressure. Then momentum traders entered, adding even more fuel. By the time silver pushed back above $76, the entire psychology of the session had changed. Fear turned into confidence. This is why silver is such a difficult market for inexperienced traders. It punishes emotional decision-making. If someone sold in panic at $74.50 today, they watched the market recover nearly $2 within hours. That is why I always say silver demands patience. It is not a metal for weak hands. It rewards conviction and punishes emotion. Now let's talk about the bigger range we are seeing. For some time now, silver has largely traded between about $70 and $80 an ounce, with occasional spikes outside that zone. Yes, we have seen brief moves toward $90, and yes, we have seen moments where it dipped below $70, but those moves did not hold. The market keeps returning to this broader range. That tells us something important. This may be the new normal. That is what I mean by a normalcy bias beginning to form. Investors are becoming accustomed to silver trading in the mid to high 70s. A year ago, that would have sounded extraordinary. Now it feels almost ordinary. That is how markets evolve. What once looked expensive eventually becomes accepted as fair value, and once that happens, the next move higher becomes easier because the market has mentally adjusted. The same thing happened with gold. Not long ago, many people thought gold at $3,000 an ounce sounded impossible. Then it crossed that threshold, stabilized, and suddenly it became normal. Now we are talking about gold above $4,500, and it no longer shocks anyone. Silver may be going through that same psychological process right now. Could silver hit $80 by the end of the week? There is one trading day left, and while it is possible, I would not call it likely. It would require another strong upside move, and that is difficult with so much volatility in the market. But what matters more than hitting $80 tomorrow is the fact that silver has recovered again and is proving it can hold these elevated levels. That is bullish. It does not mean there will not be corrections. There absolutely will be. In fact, we know Fridays have earned the nickname Smackdown Day in the precious metals world because sudden sell-offs often appear before the weekend. We saw that recently when silver dropped more than $6 in a very short period. That memory is still fresh in traders' minds, which is why many remain cautious heading into tomorrow. But here is the difference now. Even after those brutal drops, silver keeps recovering. That is the signal. Weak markets do not recover like this. Weak markets break down and stay down. Strong markets get knocked down and stand back up. That is exactly what silver did today. And that is why this move deserves attention. It was not just a bounce. It was a statement. The market is telling us that beneath all the volatility, there is still powerful support for silver, and that support may become the foundation for the next major leg higher. Now let's talk about what could happen next, because that is the question every silver investor is asking tonight. Was today simply a temporary rebound after an oversold move, or was it an early signal that silver is preparing for another leg higher? The answer depends on several factors, and as always in this market, those factors go well beyond just the price chart. We have to look at geopolitics, central bank policy, market psychology, and most importantly, the physical fundamentals that continue to support silver in the background. First, we need to talk about the geopolitical wildcard, and that remains the situation involving Iran and broader Middle East tensions. Markets are still highly sensitive to every headline coming out of that region. One unexpected development can immediately impact energy markets, risk sentiment, and precious metals. We have already seen how oil and silver have behaved during this period. While WTI crude oil has pulled back below $100 per barrel, silver has remained remarkably resilient. That tells us the market is not simply reacting to oil anymore. It is reacting to uncertainty itself. Investors continue to want exposure to hard assets during unstable periods. But eventually, wars end, or at least market attention shifts away from them. When that happens, many investors ask the same question. What happens to silver when the geopolitical premium fades? Does it collapse or does it hold its gains? My view is that while short-term speculative premium may disappear, the longer-term fundamentals remain firmly supportive. That is because silver's story today is much bigger than war headlines. Silver is still dealing with a structural supply problem. The global market has been running deficits for years. According to the Silver Institute, the market has experienced multiple consecutive years of supply shortfalls. Demand continues to exceed newly mined supply, and that matters because it means inventories slowly tighten over time. Even if paper markets create temporary volatility, the physical reality underneath does not disappear. We also continue watching CME Group warehouse inventories because those numbers tell us how much silver is readily available for delivery. That registered category is especially important. If we continue seeing drawdowns there, it strengthens the argument that physical demand remains healthy. That is one of the reasons so many long-term silver investors remain confident despite the price swings. They understand that physical silver is becoming increasingly strategic. And remember, silver is not only a monetary metal like gold. It is deeply tied to industrial demand. Solar panels, electronics, electric vehicles, medical technology, military systems, and next-generation batteries all require silver. Even if manufacturing slows in one region, like the Philadelphia data suggested today, that does not mean global demand disappears. Production may weaken in one part of the world while accelerating elsewhere, especially across China, India, and other fast-growing economies. That is why I continue to believe the medium-term setup for silver remains constructive. Could we see more volatility? Absolutely. In fact, I expect it. Silver almost never moves in a straight line. It climbs in waves, and between those waves, it often delivers painful corrections that test investor conviction. That is simply how this market behaves. Now we also need to address tomorrow's event involving Kevin Warsh reportedly being sworn in as chair of the Federal Reserve. Markets are watching this carefully, although I do not expect an immediate impact on silver from that event alone. The market has already priced in a very hawkish policy environment. Investors largely expect no rate cuts in the near term, and some even fear the possibility of higher rates if inflation reaccelerates. On paper, that should be negative for silver. But silver has been showing us something interesting lately. It has begun resisting some of those traditional bearish signals. Higher yields? Silver recovers. Stronger dollar? Silver recovers. Weak manufacturing data? Silver recovers. That is not a guarantee of future gains, but it is often how markets behave near important turning points. So as we move toward Friday, what should investors watch? First, watch whether silver can hold above $75. That is psychologically important now. Second, watch the dollar index. If it breaks decisively above 100, that could create pressure. Third, watch volume. Today's rebound came on strong volume, which gives it more credibility. If buyers continue showing up, that is meaningful. The most important takeaway is simple. Silver refused to stay down today. In a market as emotional and manipulated as this one can sometimes feel, that kind of resilience should not be ignored. It may be telling us that the next major move is not lower. It may be preparing to go higher. As we close today's market report, I think it is important to step back and look at the bigger picture, because sometimes daily price action can distract investors from what really matters. Yes, silver was volatile today. Yes, it was hammered earlier in the session. Yes, many traders probably believed another major sell-off was underway. But what matters most is how the day ended and how the market responded under pressure. Silver was tested, and silver passed that test. That is the key takeaway. When a market gets hit hard and immediately finds buyers, that tells you demand is alive. It tells you confidence remains. It tells you that even though short-term traders may be nervous, there are larger forces underneath the market that continue to support the price. Today's reversal was not just about recovering 70 or 80 cents. It was about proving that silver still has strength. And that strength matters because the environment remains challenging. The US dollar index is still elevated. Bond yields remain high. The market is still pricing in a hawkish Federal Reserve. Global uncertainty continues to dominate headlines. Normally, that combination creates enormous pressure on precious metals, especially silver, because silver is more volatile and often reacts more sharply than gold. Yet despite all of that, silver refused to break. That is exactly why long-term investors continue paying attention. I have said this many times on this channel, and I will say it again. Silver is not a straight-line investment. It never has been. If you are looking for calm, predictable price movement, silver is probably not the asset for you. Silver is emotional. Silver is dramatic. Silver will test your patience and your conviction. It will give you days where you feel brilliant and days where you question everything. But historically, for those who understand the fundamentals and stay focused on the long-term story, silver has rewarded patience. And what is that long-term story? It has not changed. The world still needs more silver than it produces. Industrial demand remains strong. Physical inventories remain something investors should monitor carefully. Central banks continue accumulating hard assets, even if most focus remains on gold. Manufacturing trends outside the United States continue supporting long-term demand. Energy transition technologies still require silver. Military applications still require silver. Medical systems still require silver. This metal remains essential. That means every major correction should not only be viewed as risk, it should also be viewed as information. Is physical demand still there? Are investors still stepping in? Are key support levels holding? Today, the answer to all of those questions was yes. Now, as we move into Friday, the day many precious metals investors jokingly call Friday Smackdown Day, we should remain cautious. Silver has surprised us before. We have seen dramatic end-of-week sell-offs, including that recent move where silver dropped more than $6 in a short window. Could that happen again? It is possible. Never underestimate volatility in this market. But I will also say this, it becomes harder to force silver lower when buyers keep stepping in every time it dips. That is what happened today. The sellers tried to push it lower, and the market rejected that move. That kind of rejection often matters. Will silver hit $80 soon? I believe it is only a matter of time. Whether that happens tomorrow, next week, or next month is impossible to know. Markets move on their own timeline, not ours. But the foundation appears to be building. The range is becoming clearer. The support is becoming stronger. And investor psychology is beginning to adapt to higher prices. That is often how major breakouts are born. So my message to this community tonight is simple. Stay informed, stay disciplined, and stay patient. Do not let short-term volatility shake your long-term thesis. Watch the fundamentals. Watch the physical market. Watch the behavior during corrections. Those are the clues that matter most. Here at Report of Silver, that is exactly what we will continue doing, bringing you the latest news, the latest analysis, and the deeper market perspective that helps you understand what is really happening in precious metals. Now I want to hear from you. Do you believe today's silver reversal was the start of another move toward $80, or was it simply a temporary bounce before another correction? Put your thoughts in the comments below, because your perspective helps make this community stronger. And if you enjoyed today's report, make sure you subscribe to Report of Silver, turn on notifications, and join us again as we continue tracking one of the most fascinating markets in the world. As always, I extend a multitude of gratitude to each and every one of you for taking the time to watch, and I will see you in the next report.